think we've seen a certain number of transactions where the 70% LTV threshold has been definitely breached, and even go up to 75. I'm not talking about necessarily men's loans or stretch lenders, but traditional German banks as well. So that was the kind of dramatic change that could have been expected, even 12 months ago, but not in such short time frame.
I think, sorry, the issue I'm concerned about here is coming from a fund management side, because that's half of what I do. I have to be very honest with my investors, and I don't like the idea of playing fast and loose with my investors' money, going up the risk-return curve. So there's probably three solutions here. The first is don't pitch your fund returns too high when you go out to market, because everybody's tempted to do that. The second is don't go and raise mega funds. But third, and probably the most avant-garde I'm going to suggest, is dare we as fund managers hand back our money to the investors and say, we didn't quite get it right or get it all out in time. And I wonder if investors would actually value that rather more than us going out there, deploying the capital and giving them a risk return that they'd never bought into in the first place, and keeping our fingers crossed it came right.
Well, I have a comment on, I agree, but I have a comment on that. The market is very dysfunctional at this moment, at least from the visibility I have in Spain, because there is clearly much more equity than debt available. And equity takes more risk normally. To some extent, that's a clear dysfunction of the market. When there is a dysfunction, there is an arbitrage to be done. It is true, I totally agree that this is totally polarized, and there are many segments. But the segments that are, clearly more intensive in equity, and there is equity behind, it will offer a great opportunity of risk return for a quarter, with lower loan value. So I totally agree that if there is the value proposition is better not to invest it, and I think that's what investors are going to appreciate. But I think there are segments in Europe, at least definitely what we are seeing in Spain, that offer once in a cycle time, to position that at risk return that we've never seen before. And it's probably not investing in Castellana, in the core building, etc. It's in kind of a different segment, but it's still getting good returns at the safe value.
But I think coming from or living in one of the smaller markets, the issue is that the debt funds normally they want pretty large tickets. And that's difficult in some of the smaller markets, as in the Nordics. There will also be some markets, probably in Spain and other places, where you need to be there on a local basis. And I think one thing is moving up the risk ladder, but it's also, I think, it's hard work, but have smaller stakes. You will also have more diversity in the risk, but I think we will have to see that because everybody will go after the same transactions.
Well, I would say there are actually, because there are a lot of segregated accounts that have been raised, and actually one thing they do need to have is diversification and not sort of having very specific risk of very large transactions. That actually a lot of it is trying to lend relatively granular. Yes, you've got the very big funds that have got raised capital, but we're seeing a lot of them doing smaller deals just because they need to have that diversification in their portfolio.
Yeah, I think you're right in the larger markets, but for a fund going into a new market, normally you would have to basically to just make the due diligence on the market, understand the market. It will have to be some kind of a minimum ticket, which is pretty large for smaller markets.
I think you're right, and I think one of the things that binds a borrower to a particular lender is the way in which you can develop that relationship with them. And if you can do repeat business, that makes a huge difference to their whole attitude. They will sacrifice points of margin and fee, or even total return on your loan, because they know that you are going to be there for them time and time again, long term.
Yeah. And usually we are opening an office in Spain in a couple of weeks, and that is basically the same reason, not only to focus on servicing, say, NPLs, but also follow some of the debt funds to say, okay, we can service, we can be your eyes and ears on the ground in certain places in Europe, because you'll need to do that.